Welcome back to another video. In this video, we are going to cover the basics of economics. We're going to break down economic events, economic indicators, and how to find them and what each one of the indicators mean. Right? So first and foremost, what is economics? So economics is the study of how society uses limited resources for production. So for example, when we look at economics help us answer the following questions, such as why are some countries rich and why are some countries poor? Economics also helps us understand what causes recessions, how many people have jobs, how many people are unemployed. It also helps us understand, are people spending more or saving more? So when we look at the overall economy, or we dig down in economics, we're able to look at the full economy. How's the economy operating? Now, the question people have is, why do we care about economics? Why do we care about the overall economy? Now, we care about the overall economy because it moves the overall market, right? So if we understand how the economy is doing and we understand certain economic indicators, we are able to take on better trades, right? So for example, let's say that we have a stock that's going up throughout the day, and we know that throughout the day there's certain economic event or report coming out. Now, if that report comes out bad, there's a high possibility that the stock that you're trading is probably going to be affected by it. So you just knowing these sets of information, you just knowing the economic indicators, knowing why the market's going up, why the market's going down, what is the root cause behind that main move up or down, is going to help you see the full picture. Now, a lot of people that are trading don't really focus on this. Even if you're day trading, even if you're scalping, knowing this set of information is very, very important as a trader, especially if you want to be in this game for a long period of time. So let's jump into the first thing. The first thing is called inflation. Now, I'm pretty sure a lot of people have heard about inflation, but they don't really understand what it is or kind of how it affects the overall economy or the market. So first and foremost, let's break inflation down. So inflation is the measure of how much each unit of currency, meaning a dollar or a euro, whatever you're using, loses its buying power, right? So let's say if inflation is 3% per year, then in 1 year's time, $1 will buy you 3% less than a year ago, okay? Now, the same $1 now has a buying power of only 97 cents. So let's break it down in simple terms. So let's say if inflation is 5%, right? If inflation is 5%, right, that means that within a year, let's say 1 full year, your buying power will decrease by 5%. Now, a lot of people, when they look at money, they don't understand the basic idea behind money. And the basic idea behind money is, in the long run, the valuation of a dollar or valuation of currency does not go up. The valuation of a dollar or a currency goes down. Meaning, if you take $100 from the year 2000, right? Let's say we go to the year 2000 and you take $100. That same $100 today is still $100, but that $100 has less buying power. Now, what do I mean by having less buying power? $100 back in, let's say, year 2000 could buy you, let's say, 300 water bottles. Now that same $100 is not or will not buy you 300 water bottles. It may only buy you 120. The reason for that is because the buying pressure of the dollar obviously goes down in the long run. Inflation kind of shows us how much is the value going down by? How much is your buying pressure going down by, right? Now, the reason inflation is important in understanding is because there's something called interest rates. So I'm pretty sure you guys have been hearing how the Feds have increased or decreased interest rates. And a lot of people ask the question, okay, what does this have to do with the overall economy? Are interest rates good or are interest rates bad? And this kind of confuses people. So interest rates and inflation kind of go hand in hand, right? So let me break that down. First and foremost, what are interest rates? So interest rates are set by the central banks or government in each economy as the borrowing rate of the central bank. Interest rates are used by economic managers to control inflation and keep it low. Now, if you guys are connecting the dots, interest rates are important and they connect with inflation, because if interest rates are not controlled, inflation will go up very high. And we don't want to see inflation go up very high, because if inflation goes up very high, your dollar loses a lot of buying power. That's why interest rates are very important, because they are controlling how inflation is going to move, right? Now, high interest rates mean higher borrowing for companies and individuals, which in turn means less money for buying goods and services, which in turn reduces demand for goods and services. So obviously, if interest rates increase, that decreases companies' profits, that decreases companies buying goods or services because the prices are increasing, right? But interest rates have to be maintained, and they have to go higher, because people might say, okay, well, why would you increase interest rates if it's going to make borrowing more expensive? Because if interest rates are not increased when they should be, then inflation will go up. And if you guys remember, if inflation gets out of control, the problem we're going to have, right, let's draw this out. The problem we're going to have is if inflation goes up too high and we keep interest rates flat, then inflation might go to, let's say, I don't know, 10% a year. So that's basically saying your dollar value is losing 10%. That is a lot. So the Feds, which I'm going to break down in a bit, they step in and they're like, wait. Interest rates, inflation is going up very fast. It's going up very high. We need to control it. Now, the way that works, right, is we have the Feds. You guys probably heard of Jerome Powell. You guys have probably heard of the Fed meeting, the FOMC meeting, which I'm going to break down. Now, the Feds, meaning the Federal Reserve, they have meetings to kind of control the economy. Now, the way it works is kind of like this. When our economy is going up very, very fast and it's growing, right, that's a good sign. That's 100% a very, very good sign. So let's say our economy, which for the past 10 years and so on, has been growing at a very strong pace. Phenomenal, great. Now, the problem with that is when our economy grows very fast, or when the economy grows very fast, inflation also goes up very fast. Now, when inflation goes up very fast and the economy goes up very fast, what the Federal Reserve do, or what they should do, is they want to slow the growth of the economy. They would need to slow this down, because if it keeps growing at this pace, there's probably going to be a huge fall, a big recession, whatever the case is, and it's obviously going to affect inflation. So Federal Reserve kick in and they're like, okay, how do we slow the economy down? We slow the economy down by interest rates. We make borrowing more expensive. So then the increased interest rate, which slows the economy down. Now, how does it slow the economy down? Is now when they increase interest rates, it makes it harder to borrow money. When it's harder to borrow money, or when it's more expensive to borrow money, less people are borrowing money. If less people are borrowing money, there's less investments made, there's less businesses started, there's less output in the total overall economy, and that's slowing the economy down. And the purpose of that is that they're slowing the economy down to control inflation. And majority of people don't understand that, and they go, well, why would you want to slow the economy down? The economy is growing very fast. Yes, the economy is growing very fast, and that's good, but that's also affecting inflation. So interest rates need to step in, and they need to be increased to keep everything well balanced. Now that goes to my next point, right? The next point is the goal is to keep inflation and interest rates stable while also managing a growing economy. So that's where the Federal Reserve kick in to keep everything balanced. And the reason I'm breaking this down to you guys is because when you're trading and you hear these set of news, I want you to understand. I want you to understand what it means, right? A lot of people don't focus on that. They think, okay, if I know price action, I'm scalping or I'm day trading, I don't need to know all that stuff. But if you really, really think about it, and if you want this to be a career and you want to be invested into this for the long run, it's very important for you to understand all of these logistics and all of these pieces of information. So when it does get presented, you're able to think from a logical standpoint of view, right? Now, let's break down certain economic events to watch out for. So there's certain events that happen, right, and certain major market movements that drive the market up or down, depending on if it's good news or depending on if it's bad news, right? So let's break that down. The first is something called FOMC meetings, right? This is where the Federal Reserve has meetings regarding the interest rates and monetary policies, and they decide what they're going to do. So this is a very, very, very big day. So whenever they have this meeting and whenever they announce the result of this meeting, you'll see the markets are usually very, very choppy, or they trade sideways. The second is when the announcement is made, the market usually gets some sort of direction depending on what happens in these meetings. So whenever you see that there's a Federal Reserve meeting, and I'll show you where you can find it, when they happen in a bit, but whenever you see that this meeting is happening, you're going to see that the market is very choppy that day, or very choppy the day before or the day of, right? And it's just very important to know when these set of events are happening so you as a trader can better prepare yourself. Now, the second major event, it's not really an economic event, but it drives the overall economy up or down, is earning results from blue chip companies. So blue chip companies could be anything from Apple, Microsoft, Amazon, right? So what happens is a lot of people are watching how these companies perform. And now this is where I want you guys to think a little bit, right? Now, earnings results from a blue chip company, how is that a very important economic event or a major market driving event? Because they showcase the general health of the economy and how individual companies are performing, right? So for example, let's say Apple reports earnings and they report that from last year, let's say last year Apple had revenue of 100 billion. This year they have revenue of 140 billion. Just throwing out random numbers. Now looking at this, you can see that Apple grew in revenue, that they're selling more products. Now if you just logically think about it, right, why is that important, knowing if a company like Apple, Amazon, are they selling more or less? Because that showcases us how the overall economy is doing. Because if people are able to spend more money on an iPhone, on a laptop, on these products, that means they have money. That means the economy is growing. That means they have extra money to spend. Now, if Apple's sales start decreasing, right, and not just Apple, because obviously it could be a point where all Apple's maybe not a good company. But if Apple, Microsoft, Amazon, big name companies' sales start going down, now it's like, wait, hold on. Why are people not buying the new iPhone? Why are people not buying the new Samsung phone? Why are people not shopping on Amazon as much? What's happening with the overall market? Do people not have enough money? Are people not finding jobs? Wow, this is a big concern. So this is another thing a lot of people watch out for during earnings season. How are big names performing? How are their earnings coming out? What are the numbers? Are they growing? And so on, just to kind of dictate how the overall economy is performing. Now, next 2 points are unemployment figures. So the first Friday of every month, we have unemployment figures. We have an unemployment report that comes out, and this report is heavily watched by a lot of people. And this is a very important report because it showcases how many people are actually unemployed, how many people have jobs, and this key figure helps us understand how the overall economy is performing. And this figure is also used by the Feds, right, to dictate what they're going to do with interest rates, because they're kind of collecting pieces for the overall economy, right? And then the final economic events, major events, are powerful figures speaking. So for example, if Trump is speaking, or the president, whoever the president may be, if any president speaking, especially let's say Trump, let's say Jerome Powell is speaking. Jerome Powell is the head guy of the Federal Reserve, or any of the Fed members, or any powerful figure speaking, they have the power to move the market up or down. So if Trump comes and he says something such as, hey, we are having, or we are not having a deal with China. China is not agreeing with the deal. Him saying something like that could obviously affect the overall market. Jerome Powell, the guy from the Fed, if he comes out and says, oh, we're not looking to cut interest rates, that may affect the overall market. So when they're speaking, and once again, I'll show you where you guys can find these major events. Whenever any powerful figure is speaking, we have a Fed meeting, earnings, unemployment figures, anything major is happening, you guys just need to be alerted and kind of be aware that, hey, this is what's going on. Because if you're not, and you're in a trade, you're going to get caught up in a trade without really knowing the big picture. Now, these are some economic indicators to watch out for. So if you guys take a look here, these are all of the economic indicators. I'm going to break them down. There's a bunch of them. I'm going to show you what each one of them means, and I'll show you where to find them. And these are economic indicators. Once again, you guys are going to see a lot of times what the market is going to be focused on. Now, you don't have to remember each and every single one of them by end of this video and say, okay, let me remember them. I need to know it 100%. No, if you're just aware and you have a basic idea on them, you'll be good. Because we as traders, we don't really care how the economy is doing. We just want to have an idea so we know how to take on certain trades, right? I don't care if we go through a recession or not, right? If we go through a recession, cool. As a trader, from a trading perspective, you still have opportunities. The market is going up based on good economic indicators. Now I know how to approach the market. If the market's going down based on bad economic indicators, I now know how to approach the market. So me as a trader, me knowing these sets of information is just me being aware and me just preparing myself on how to attack the market. Now, where can I find all these reports? Before I jump into the reports, I want to show you where you can find them. So there's this website that you guys can see right here. You guys can go on this website, and there's the economic calendar. So the economic calendar looks something like this on a weekly basis, and I break this down on Discord. We have a section there where on a weekly basis before the week starts, I break down, hey, this week, this is what's happening. This week, that's what's happening. So if you guys look at this, right, this is breaking the week down of October. So you can see October 7th, Jerome Powell speaking, Jerome Powell speaking, Jerome Powell speaking, FOMC minutes, right? Now, minutes are different than the actual meeting. I'll break that down in a bit. But you can see the day he's speaking, and obviously this doesn't happen every week. This is just happening in this week. The market becomes very choppy because he can say something positive or negative, and that will obviously impact the overall market for that day. So if you're scalping or you're day trading, knowing this is extremely important because think about it. He speaks at 1 p.m., right? And let's say at 1:30 p.m., he says something bad that the overall market doesn't like, and market starts selling off. You might be in a position where you're anticipating that the stock is going to go higher. Cool, great setup, but now with this set of news, there's a high possibility your stock is going to pull back or sell off, right? So just being aware, guys, that's very, very important. And when you look at the full economic report, you can see the CPI, jobless claims, right, consumer sentiment. All of these things are right here on the website. You guys can check it out on a weekly basis, and usually everything in red and green is what we're focusing on, and that's what we care about, right? So let's break down the first economic indicator. So there's something called a consumer price index known as CPI. So you guys are going to be seeing this a lot. So what is it? The consumer price index is a measure of the change in the average price level of a fixed basket of goods and services purchased by consumers. So what does that mean? So for example, let's say if someone borrows $100 from you today and promises to repay it within 1 year with interest, how much interest should you charge? The answer depends largely on inflation. As you know, the $100 will not be able to buy the same amount of goods and services a year from now, okay? The CPI tells us that the price rose 4.2% in the US over 2000. To recoup your purchasing power, you would have to charge 4.2% interest. You might want to add 1 or 2% points to cover default and other risks. Now, in simple terms, it's kind of like this. So let's say, as I just explained, I lend you $100 right now. And I'm like, okay, I'm lending it to you. I want it back within a year. Now, within a year, inflation plays a role too. Now, inflation might be 5%. So in a year, this $100 is not really $100. It's $95. The buying power of it is $95. So me knowing that, I'm like, okay, how much interest can I charge? How much interest should I charge? A, I lose 5% of inflation. B, besides inflation, do I want to make any money? Besides inflation, do I want to charge any extra additional interest? I might say, no, cool, just pay me $100 plus 5%, pay me $105. Why? Because if you pay me $105, I get the same purchasing power that I had a year ago. Okay. Now, if I want to charge interest and I want to make money, cool, that's a whole nother story. So that's what the consumer price index kind of shows us, right? Now, it's important because it showcases us, it's a huge indicator for inflation, right? It's followed on a monthly basis. It shows us what's happening with inflation, and it's heavily watched by a lot of people, and this is a market moving indicator. Frequency it is released once a month. The website I showed you guys can go on that website, and this comes out once a month, and you can see when it does and kind of analyze it from there. Now, as I mentioned before, just to kind of bring it up again, you guys don't have to look at this and analyze this and say, okay, what was the consumer price index? What should I do? No. Knowing about it, knowing that it comes out tomorrow at 10 a.m., and knowing at 10 a.m. you kind of got to be careful. When it does come out, was it good? Was it bad? How is the market going to be in the next few minutes? That's where the benefit is from, especially if you're trading, right? Now, next, consumer sentiment. So what is it? So the University of Michigan's Consumer Survey Center questions 600 households each month on their financial conditions and attitudes about the economy. Consumer sentiment is directly related to the strength of consumer spending. Now, the importance is the pattern in consumer attitudes and spending is often the foremost influence on the markets. Strong economic growth translates to healthy corporate profits and higher stock prices. Frequency released once a month. So consumer sentiment basically just shows us how a consumer is basically feeling about spending money. Now, obviously, a stronger consumer sentiment shows us that consumers are confident. If they're confident, that means they're going to spend more money. Them spending more money is going to translate into higher corporate profits. So if consumers are spending a lot of money, companies like Apple is going to make more money, right? Microsoft, Amazon, so on. If they make more money, their stocks are going to go up. Their stocks going up is going to drive up the overall market. So that's what consumer sentiment kind of is. Next, we have consumer confidence. Now, consumer confidence, what is it? The headline Consumer Confidence Index is based on consumers' perceptions of current business and employment conditions, as well as their expectations for 6 months. The pattern in consumer attitudes and spending is often the foremost influence on stock markets. Strong economic growth translates into healthy corporate profits and higher stock prices. Frequency, it's also released once a month. Now, this is just showing us the confidence level that consumers have as well. It's factoring in a little bit different sets of information, but you're going to see the consumer sentiment, confidence kind of all align in the same basis. These are heavily watched to see if the economy is slowing, if the economy is accelerating, what's happening with the overall economy, what is the strength of the overall economy at the current moment. And this is released on a monthly basis as well. Next, we have the employment report. What is it? So the employment report is a set of monthly labor market indicators based on 2 separate reports. The Establishment Survey, which tracks 650,000 work sites and offers the non-farm payroll and average hourly earnings headlines, and the Household Survey, which interviews 60,000 households and generates the unemployment rate. So the idea is that this gives us a report of how many people are looking for a job, how many have a job, how many need a job, what are they getting paid, and how many hours they are working. These numbers help us identify the future direction of the economy, right? Now, this also shows us everything by sectors. What sectors are increasing in jobs? What sectors are decreasing in jobs? So a lot of people that trade off sectors look at this too, look heavily into the report to understand what's happening with the overall economy. Now, obviously, if unemployment rates are going low, they're going down, they're decreasing, that means people are getting more jobs. If there's more jobs, that means the economy is healthy. Obviously, if jobs are not present, people are unemployed, that means people are going to spend less money. If people are going to spend less money, that's going to drive the overall economy down, right? So this is another report that's heavily watched. This comes out once a month. This comes out on the first Friday of every month. So the first Friday of every month, you guys are going to see the employment report, and it's a very important report. Next, GDP. Pretty sure a lot of people have heard about this. So what is the GDP? The GDP measures the economic activity of the output of products and services located within a country. So obviously every country has a certain GDP. So what's important is GDP is the all-inclusive measure of economic activity. Investors need to closely track the economy because it usually dictates how investments will perform. Investors in the stock market like to see healthy economic growth because robust business activity translates to higher corporate profits. This is released quarterly. Now, as I mentioned, a lot of people might be looking at these economic indicators and say, oh man, I don't understand it. I need to fully know what is the GDP, what is the consumer sentiment, and dive into it. Now, if you're trading, guys, you don't really have to dig in depth with it. Now, if you're swing trading, you're investing, then obviously looking at it, understanding it at a deeper level and applying it is very important. But my idea with this for people that are looking to just trade, scalp, day trade, whatever the case is, just understanding it, knowing when it comes out, and having a basic understanding of what it means and how it affects the overall market is very important because it allows you to trade better and trade higher quality setups, right? Next, the Federal Open Market Committee, FOMC. What is it? So the Fed determines interest rate policy at the FOMC meetings. These happen roughly every 6 weeks and are the single most influential event for the markets. So this is what everyone is watching. This is when the Feds have a meeting. So this is what I was talking about before, the FOMC meeting. Now, when this happens, all eyes are on the announcement. Everyone is on the announcement. Oh my God, what are they going to do? Are they going to cut rates? Are they going to increase rates? What are they going to say about the future? So everything gets focused on the Feds at this exact moment. The interest rate is set by the Fed. The federal funds rate serves as a benchmark for all other rates, right? So basically, as I mentioned, their whole focus is to increase rates, decrease rates, set monetary policies, and so on. So that's what's happening at this meeting. That's why it's heavily focused on. That's why everyone's watching it. They're just looking to see what the Feds are looking to do, what they see in the economy. Do they see growth? Do they see that the economy's slowing down? What are they doing with the overall rates? So this is a very, very important event that happens in the market. And this happens 8 times a year. And once again, if you go on that website, you can see when it happens, when the dates are, and kind of just be alerted on that. Next, we have something called the Beige Book, right? Now, this book is produced roughly 2 weeks before the monetary policy meetings of the Federal Open Market Committee. So before the Feds have the meeting, this is produced 2 weeks before. This report on economic conditions is used at the Fed meeting where the Fed sets interest rate policies. This also happens 8 times a year. We get this information, we can look at it. We look at what the Fed are going to look at in their meeting. Once again, you don't have to really go in and look at this. You can if you want, depending on your trading style. Me personally, I don't. I just kind of know what it is. So when I see it, depending on how the market moves, I kind of know, like, okay, the market obviously didn't like what was presented here. The market maybe liked what was presented here. So I kind of know what's happening with the market. That's what the whole idea of this is. Now, if the market just randomly goes up and I see some word or some economic indicator I've never seen, I'm going to be very clueless. So I need to know or have a solid understanding of what these things mean and how they impact the overall market. Next, FOMC minutes. So this is what a lot of people confuse. They confuse the FOMC minutes with the meeting. Now, the FOMC minutes, right, is basically the meeting notes. So the Federal Open Market Committee issues minutes of its meetings with a lag. So whenever the Fed has their meeting and their meeting is done, they then release the minutes. They basically release notes from that meeting 3 weeks after. Now, in that meeting, whatever has happened, people look at the minutes, they look at the report to look at certain clues. Okay, what did this say? What was said? Blah, blah, blah. So they start putting the pieces together. This comes out 3 weeks after the original meeting, right? And this also happens 8 times a year. Next, we have retail sales. So retail sales, when this report comes out, it just shows us the total receipts at stores that sell merchandise and related services to final consumers. Sales are by retail and food services stores. So whenever this comes out, it just shows us how retail sales are doing. Are they up? Are they down? Now, obviously, if you just kind of think about it, retail sales being up shows us a strong economy. Retail sales going down kind of shows us maybe a weak economy. People are probably not spending as much. Now, when you start connecting the dots, and this is what I want you guys to think about for a second. So if any of you guys are kind of zoned out, let's lock in for a second, right? Now, Retail sales. Think about this. This is what I want you guys to do. I want you guys to be able to think and apply. I don't want you just to take notes and try to remember stuff. I want you to be able to think, because when you're in the market, you have to think and clearly be able to see everything from a strategic point of view. Now, let's say retail sales comes out tomorrow morning. And retail sales are down heavy. Now, if retail sales are down heavy, who do you think it's going to affect? What big names is it going to affect? What trades are present? The trades that are present are in companies like Target, Kohl's, Macy's, right? Because if retail sales economic indicator comes out and it's low, that is going to affect a lot of retail stores, maybe like Walmart. So our trade ideas could go into a lot of the retail companies. All right, the report came out, report's bad. That means a lot of the retail names are probably going to be affected because their sales are probably down for the next quarter. So this is where you start identifying plays. This is where you start putting the pieces together and you start seeing a bigger picture, right? Next, we have new home sales. So what is it? New home sales measures the number of newly constructed homes with a committed sale during the month. The level of new home sales indicates housing market trends and in turn economic momentum and consumer purchases of furniture and appliances. So this basically shows us demand for housing and the economic momentum. People basically have to be feeling pretty comfortable and confident in their own financial position to basically buy a house. And this is released once a month. Next, we have existing home sales. These are not homes that were newly built. These existing homes, same exact concept, right? It's showing us how consumers feel, right? They're confident. People are in a good financial condition. So home sales or existing home sales, new home sales or existing home sales going up is a pretty strong indicator for the economy. Once again, released once a month. Next, we have something called a PMI Manufacturing Index. So this is based on monthly questionnaire surveys of selected companies. The Purchasing Managers Manufacturing Index, PMI, offers an advanced indication on month-to-month activity in the private sector economy by tracking changes in variables such as production, new orders, stock levels, employment, prices across manufacturing industries, right? So investors need to keep their fingers on the pulse of the economy because it dictates how various types of investments will perform. So this is also an indicator that's watched by a lot of people just to see how the overall economy is doing. And if you guys start putting the pieces together, all of these indicators obviously affect the overall economy. They're measuring different stuff, but at the end of the day, it's affecting the whole market overall, right? This report also comes out on a monthly basis. Next, we have something called ISM Manufacturing Index. What is it? So this is the Manufacturing Composite Index from the Institute for Supply Management, which is a diffusion index calculated from 5 of the 11 subcomponents of a monthly survey of purchasing managers at roughly 300 manufacturing firms nationwide. Now, I don't want to get into a full definition and keep explaining that because I'm going to lose people. But in general, in simple terms, these measurements, right, are all looking at different components. So this one is looking at inventories, customer inventories, orders, backlogs, employment, supplier deliveries, exports, imports, prices. So that's what this index is tracking. So what it does for us, it allows us to see, once again, how the economy is doing, right? But it's calculating different components to identify that. Now, once again, depending on how you're trading, if you're day trading, scalping, just knowing what it kind of means, knowing when it comes out is primarily what you want to know. Now, knowing, wow, what was the order backlogs? What was the supplier deliveries? I need to know these numbers probably isn't as relevant to you. To be honest, I don't really look into that. I just know, okay, tomorrow at 9:35 p.m., the ISM Manufacturing Index report comes out. Be aware, be alert. Came out good, came out bad, market tanked, cool. Is there a play? Is there not a play? And this also comes out on a monthly basis. And then next, last thing that I have up here, I have construction spending. So what is it? The dollar value of new construction activity on residential and non-residential and public projects. Data are available in real dollars, right? So basically, when you look at construction spending, it shows us, obviously, if construction spending is going up, people are spending more, there's more investments happening, more homes are being built. This is showcasing that home builders or contractors are investing more, they're having more business, which is obviously growing the overall economy, more investments are made, which is obviously affecting interest rates, business cash flow, and so on. So just looking at this as well shows us, once again, the overall economy, how the overall economy is performing, and this comes out on a monthly basis. Now, just to recap everything, just to put everything in perspective, yes, there's a lot of economic indicators, and there's more than what I've kind of broken down. Now, what I want you guys to understand, because I know by now people are like, oh my God, I got to go through each one, I got to understand it at a deeper level. Guys, if you're just going to day trade, if you're just scalping, maybe swing trading for a little bit, you don't have to dig inside that deep. Now, if you're someone that's investing, right, and you really want to understand the markets, yes, understanding these numbers, breaking it down, going in deeper, researching it is going to play a huge role. But me personally, I know all of these from the surface, but do I know what the number was for the ISM report last month? No, I don't know. Was it good? Was it bad? That's a different story, right? Knowing when it comes out, knowing if it's good, knowing if it's bad, when it does come out, having a certain setup in the market is what I care about. But I don't really care about going into the report and really understanding it. So that's what I want you guys to take away. So I went over this whole topic so you guys can see the market from a bigger picture, and you can start understanding the moving pieces better, instead of just seeing price action, saying, wow, a stock went up, wow, a stock went down. Why did a stock go up? Why did a stock go down? And looking at the economic events is one of the biggest reasons on a stock going up or down, and understanding it is very, very important.